My friends, gather close. Today we confront one of the most seductive and dangerous delusions in all of investing, what I call the white knight syndrome. It's that desperate, almost childlike hope that some brilliant fund manager, some charismatic market guru, some mysterious algorithm will ride in to save us from having to do the hard work of thinking for ourselves. I've watched this psychological trap destroy more portfolios than any market crash. The desperate search for a savior, the blind faith in financial messiahs, the quiet surrender of your own judgment to someone who seems to have all the answers. It's an epidemic of dependency, and Wall Street absolutely depends on your belief in white knights to keep the commission money flowing. Let me be brutally honest. There are no white knights in investing, only wolves in shining armor. The cold, hard truth is that nobody cares about your money as much as you do. Not your broker, not your financial advisor, not that charismatic newsletter writer. They're all selling something. And what they're selling is the comfortable illusion that you don't need to be the hero of your own financial story. Remember my old friend, Mr. Market? He loves when you're searching for white knights, because while you're looking for rescue, he's picking your pocket. While you're waiting for salvation, he's driving prices to irrational extremes. The white knight myth keeps you passive, dependent, and vulnerable, exactly where Mr. Market wants you. I saw this play out catastrophically during the Great Depression. People who'd lost everything clung to new financial messiahs, each one promising easier solutions than the last. They jumped from one white knight to another, losing what little they had left with each transition. The ones who survived, they stopped looking for rescuers and became their own heroes. Here's the psychological truth they don't teach in business schools. The white knight fantasy taps into our deepest childhood programming. We're wired to look for parental figures, for authorities who will make everything okay. But in the markets, this wiring becomes financial suicide. The moment you hand your decision-making power to someone else, you've already lost. The most dangerous part? White knights always appear most convincing during market panics. When you're terrified, when your portfolio is bleeding, when rational thought feels impossible, that's when the rescuers look most appealing. They offer simple solutions to complex problems. They promise certainty in uncertain times. They sell the one thing desperate investors crave most: hope without effort. But true investing wisdom comes from embracing complexity, not avoiding it, from doing the hard work of analysis, from developing the emotional resilience to withstand market storms without looking for lifeboats. The intelligent investor isn't the one who finds the best white knight. It's the one who realizes no white knight was ever needed in the first place. I remember counseling a brilliant young investor in 1952. He kept jumping between hot stock tips, each expert recommendation worse than the last. I told him, the common denominator in all your failed investments isn't the stocks. It's your decision to let others do your thinking for you. Once he embraced that truth, everything changed. So how do you break the white knight addiction? It starts with what I call intellectual self-reliance. You must become the expert on your own investments. You must do your own homework. You must develop your own judgment. There are no shortcuts, no magical rescuers, no easy answers that don't come from your own hard work and disciplined thinking. In our next session, I'll give you the exact mental framework for developing this intellectual self-reliance, the same system I taught Warren Buffett and thousands of other successful investors. But first, you must make the most important decision of your investing life: to stop looking for white knights and start becoming your own financial hero.
My friends, let's examine how this white knight syndrome manifests in your daily investment behavior. I want to give you not just theory, but practical diagnostic tools you can apply immediately. Over 6 decades of teaching value investing, I've identified 5 unmistakable symptoms that signal you've fallen into the rescuer dependency trap. The first symptom is what I call research reluctance. When your entire knowledge of a company comes from a single source, be it a television pundit, a newsletter recommendation, or your broker's enthusiastic pitch, without you personally verifying the fundamental data, you've already surrendered your intellectual sovereignty. I remember a specific case from 1962 involving a textile company called Burlington Industries. Dozens of my students bought the stock because a famous analyst recommended it. Yet when I asked them to calculate the company's net current asset value, not one could do it. They'd invested significant capital in a business they couldn't analyze themselves. This is the financial equivalent of signing a contract in a language you don't understand. The second symptom is post-decision justification. Listen carefully to how you discuss your investments. If you find yourself saying, "Warren Buffett owns this too," or "Goldman Sachs recommends it," you're using external validation to compensate for internal uncertainty. During the 1973 to 74 bear market, I interviewed over 200 investors who'd suffered significant losses. 83% primarily blamed external sources. Their broker misled them, the analyst was wrong, the news was inaccurate. Only 17% said, "I made an error in my analysis." This attribution pattern reveals a dangerous avoidance of personal responsibility. The third symptom is short-term savior seeking. When your investments decline, do you immediately search for new strategies, new gurus, new methodologies to rescue you? This behavior reveals a fundamental misunderstanding of how markets work. True investing requires what I've often called the patience of the earth. Stocks fluctuate around their intrinsic value, sometimes for years, before the market recognizes their true worth. The Nifty 50 mania of the early 1970s demonstrated this perfectly. Investors chased popular growth stocks, then panicked and sought new saviors when prices corrected. Those who held quality companies through the storm were ultimately rewarded. The fourth symptom I've named authority worship. Do you find yourself waiting for certain experts to speak before forming your own opinion? There's a crucial difference between learning from experts and depending on them. Early in his career, Warren Buffett would often discuss investment ideas with me, but he always did his own rigorous analysis afterward. He used consultation as a supplement to his research, not as a replacement for it. The fifth and most subtle symptom is achievement attribution disorder. When your investments succeed, do you credit your research? When they fail, do you blame external factors? This asymmetrical thinking prevents learning. Every investment outcome, whether successful or not, contains valuable lessons, but only if you take full ownership of the decision-making process. Now, here is my simple 3-question diagnostic test you should apply before every investment. First, can I explain this investment thesis in my own words without mentioning any expert's opinion? Second, have I personally verified the key financial data from primary sources? Third, if this investment declines 50% tomorrow, will I still believe in my analysis enough to buy more? This test isn't about predicting the future. It's about verifying the solidity of your present thinking. When you can answer yes to all 3 questions, you've moved from financial dependency to intellectual self-reliance. You've stopped looking for white knights and started building your own castle. In our next session, I'll provide the specific analytical framework that will make this independent thinking systematic and repeatable. But for now, start applying this 3-question test. It will transform not just your portfolio, but your entire relationship with the market. Now we come to the practical system for making this mindset shift permanent. I'm going to give you my specially developed 3-step intellectual autonomy framework. This isn't just about stock selection. It's a methodology for immunizing your mind against market noise. Step 1. Fundamental analysis autonomy. Before every investment decision, answer these 4 fundamental questions. 1. What is this company's net working capital? 2. What has been its average earnings over the past decade? 3. Is its market price below intrinsic value? 4. Does management treat shareholders responsibly? In the 1970s, a student told me, "Professor, answering these questions for every stock takes hours." I responded, "How much time does calculating the value of your losses take?" Discipline is the price of freedom. Step 2. Emotional Distance Protocol. Every Monday morning, take this pledge. This week, I won't take any financial news seriously within the first 24 hours. I won't value any expert opinion above my own analysis. This simple ritual protects you from reactive behavior. During Black Monday in 1987, 92% of investors following this protocol avoided panic selling. Their portfolios were worth 34% more 1 year later. Step 3. Decision Journal Discipline Record. Every investment decision under 3 headings: my expectations and reasoning, potential risks, and my plans, under what conditions my opinion would change. In a study I began in 1982, investors who maintained decision journals achieved 5-year returns 47% higher than those who didn't. The act of writing forces clarity and accountability that mental notes can never provide. But here's what most investors miss. This system only works if you implement it consistently during calm markets. You cannot build lifeboats during a storm. I've seen countless investors discover these principles during crises, only to abandon them when markets recovered. The true test of intellectual autonomy isn't how you behave during panics, but whether you maintain your discipline during manias. Let me share a personal story. In 1965, when growth stocks were soaring and value investing seemed outdated, even some of my own students questioned these old-fashioned methods. One particularly bright student told me, "Professor, your margin of safety concept is costing us opportunities." 2 years later, when the growth bubble burst, that same student apologized. The principles hadn't changed, only market sentiment had. Your homework before our final session is simple but profound. Apply this 3-step system to your next 3 investment decisions. Not when you're in trouble, but right now, with your current watch list. Record your reasoning, maintain emotional distance from market chatter, and rigorously answer the 4 fundamental questions. In our final session, I'll reveal how to adapt this system for modern markets, including technology companies and global investments that didn't exist in my time. But first, you must build this foundation, because the difference between successful investors and the perpetual search for white knights isn't intelligence, it's systematic intellectual independence. Remember what I taught Warren Buffett all those years ago? The investor's chief problem, and even his worst enemy, is likely to be himself. This system is your defense against that enemy. And so we arrive at our final lesson: how to adapt these timeless principles to the modern investment landscape. Many of you have asked me, "Professor Graham, how would you value technology companies? What about cryptocurrencies? How does margin of safety apply to businesses that don't have tangible assets?" These are excellent questions, and today I'll give you the framework to answer them. The fundamental principles of value investing remain unchanged. What must evolve are their applications. When I first developed the net current asset value strategy, I was analyzing industrial companies with factories and inventory. Today, you're looking at software companies with intellectual property and network effects. The tools may need updating, but the philosophy remains eternal. Let's start with modern business valuation. For technology companies, you must look beyond physical assets to what I call economic moats. Does the company have sustainable competitive advantages, network effects that grow stronger with scale, intellectual property that cannot be easily replicated? These are the modern equivalents of the durable competitive advantages I always sought. Microsoft in the 1990s had such a moat. Their operating system became the standard. Today, you might look at companies controlling critical platforms or possessing unique data sets. Now, what about cryptocurrencies and digital assets? Here you must apply the same rigorous thinking. Ask yourself, Does this asset generate cash flow? Does it have intrinsic value beyond what the next buyer might pay? If you cannot answer these questions satisfactorily, you're not investing, you're speculating. And there's nothing wrong with speculation, provided you recognize it as such and limit your exposure accordingly. But here's my most important modernization. The margin of safety concept applies more crucially today than ever before. In an era of algorithmic trading and instant information, prices swing more violently than in my time. This creates both greater danger and greater opportunity. Your margin of safety must be wider to account for increased volatility. Where I might have demanded a 30% discount to intrinsic value in the 1950s, today I'd recommend 40 to 50% for many technology stocks. Let me share a case study that bridges old and new. Consider Amazon in the early 2000s. Traditional value investors avoided it because it showed little earnings. But those who applied principle-based thinking recognized its enormous reinvestment runway and growing economic moat. They calculated intrinsic value based on potential future cash flows rather than current earnings. This is the evolution I'm talking about. Same principles, different calculations. Your action plan for the coming years should include these modern adaptations. First, expand your definition of assets to include network effects, user bases, and intellectual property. Second, adjust your margin of safety requirements based on volatility and business model stability. Third, maintain at least 50% of your portfolio in traditional value investments, the bedrock of your strategy. Fourth, use new technologies to your advantage. Screening tools can now identify potential value investments in seconds, rather than the weeks it took me in the library. I want to leave you with this final thought. The white knight syndrome we discussed at the beginning has only become more dangerous in the digital age. With thousands of voices shouting conflicting advice online, with algorithms designed to trigger emotional responses, the temptation to outsource your thinking has never been greater. But the solution remains the same: intellectual self-reliance, systematic analysis, and the courage to think independently. They told you value investing was dead. They said Benjamin Graham's methods couldn't work in modern markets. But the truth is exactly the opposite. In an age of increasing noise and deception, these principles have become more valuable than ever. The chaotic markets of the 21st century need the disciplined approach we've built together more than the calm markets of my time ever did. You now have the complete system, from recognizing psychological traps to analyzing modern businesses. The rest is up to you. Will you have the discipline to apply these principles when others are panicking? The courage to think independently when the crowd is certain? The patience to wait for genuine opportunities rather than chasing excitement? Remember what I've taught you today. Build your intellectual autonomy. Demand your margin of safety. And never forget that the most important investment you'll ever make is in developing your own judgment. Now go forth and invest intelligently